All right, let's just dive right into this. Welcome, everyone, to today's Explainer, where we're breaking down what is easily one of the most spectacular and, frankly, dramatic market movements we've seen all year. We're looking back at the incredibly chaotic week leading up to May 16th, 2026. This was a week that completely exposed a massive collision between political turmoil and some really deep economic fragility over in the UK. Now, if you follow global markets, you know that currencies are basically the vital signs of a nation's economy. And right now, the British pound is blinking red. So we're going to uncover exactly what happened here, step by step. To instantly get a sense of the stakes we're dealing with, just take a look at this single number, negative 2.1%. In literally just 5 days, the pound dropped from an opening of 1.3607 all the way down to a low of 1.3321 against the US dollar. Now, in the world of major foreign exchange, a 2.1% drop in a single week is an absolute earthquake. In fact, this marks the pound's worst weekly decline since November 2024. This wasn't just a gentle slide, it was a ruthless, panic-driven downward spiral. And you can really see the scale of that spiral when we map out the 7 major currencies for the week, because a massive divergence pops right out. On one side, you've got the Australian dollar claiming the title of the absolute strongest currency, with a massive advantage, heavily bolstered by the support of stable commodity prices. But on the exact opposite end of the spectrum, sitting dead last, is the British pound. It was the absolute weakest performing currency of the week, and it actually tied with the US dollar for the highest volatility. So the stage is set. While other global economies are finding solid ground, the UK currency is just plunging. Which brings us to the core mystery of our explainer today. Why did this happen right now? Because honestly, there's a huge paradox here. On Monday of that very same week, the UK's Office for National Statistics actually released positive data. First quarter GDP increased by 0.6% month over month, which beat market expectations, and it was largely driven by the service industry. Now, normally, an economic beat like that sends a currency higher. Yet the pound collapsed anyway. It just completely ignored the good news. To understand why, we've got to look at what I call the iceberg model of this crisis, starting right at the surface. Part 1. Political turmoil shocks markets. So the surface layer of this whole iceberg is the immediate, frankly chaotic political news cycle that unfolded that week. It actively shocked the markets and basically overrode any positive economic data. Let's just walk through this timeline together. We already know Monday provided that 0.6% GDP beat. But then came Tuesday. British Prime Minister Starmer delivered a speech that was entirely intended to stabilize morale. But, it was a classic case of please remain calm, causing an absolute stampede. Capital markets took one look, voted with their feet, and basically gave the government a massive slap in the face by sending bond yields soaring. Then, on Friday, the whole situation fractured even further. Andy Burnham, the mayor of Greater Manchester, successfully returned to the British Parliament through a by-election. This political shift completely shattered whatever tiny bit of market confidence was left, directly triggering widespread panic right before the weekend. And if you want to understand just how badly that Tuesday speech landed, check out this stark warning. The chief economist of the Allianz Group literally came out and said the UK is repeating the Truss moment in 2022, and the political turmoil is questioning the credibility of the UK's finance. Now, if you remember the massive 2022 tax reduction crisis under Liz Truss, you know that is the ultimate red flag for investors. When the credibility of a G7 nation's finances is openly questioned by major global institutions, capital flees, and that is exactly what we saw happen to the pound. And wow, does this illustrate the cost of that lost credibility? Just look at how the UK's yield totally towers over its peers here. See, when a country's risk goes up, the interest rate they have to pay investors to borrow money goes right up with it. On Wednesday, right after Starmer's speech, the UK 10-year yield jumped to 5.116%. By Friday, after Burnham's election, it hit 5.133%. That is the highest level since the 2008 financial crisis. Meanwhile, the US is at 4.45%, and Germany, which is famous for strict fiscal discipline, is sitting comfortably at just 3.10%. The UK's 30-year bond yield even soared to an unbelievable 5.802%. Basically, the UK is currently paying a massive premium literally just to keep the lights on. Moving into part 2, the long-term dead bomb. So to really grasp why a couple of speeches and a single by-election sparked such a historic bond spike, we've got to dive below the surface. We are entering the deep-rooted structural crises that are actively pulling the pound down. The first is a massive ticking debt bomb. Just look at the sheer scale of this. Net public sector debt in the UK has reached an astounding 93.8% of GDP.
To put that into historical context, this is the highest level of debt the country has carried since the 1960s. And when your debt is this large, the interest payments alone become a monumental burden. Annual debt interest expenses are now projected to reach an eye-watering £111.2 billion. This isn't money going into roads or hospitals or schools. This is a staggering amount of capital that's just burned simply to cover the cost of carrying the debt.
And because that debt load is just so high, the government is caught in this brutal mechanical trap. It's a total vicious spiral. Step 1, political turbulence scares investors. Step 2, that fear causes bond yields, meaning borrowing costs to rise. Step 3, higher borrowing costs mean the government has to spend even more of its budget on that £111 billion interest bill, creating intense financial pressure. Step 4, that financial pressure leads to budget cuts or tax hikes, which circles right back to step 1, more political turbulence. In fact, modeling from TechMill actually estimates that political uncertainty alone is adding a 50 basis point risk premium to UK bond yields, so the politics are literally making the debt more expensive by the second. Section 3. The stagflation dilemma. Even if the UK could magically fix all its political drama tomorrow, it's still suffocating under a really perilous macroeconomic environment. The economy is basically trapped in the ultimate central banking nightmare, stagflation. This is where high inflationary pressures are stubbornly colliding with weak, stagnant economic growth. Remember that 0.6% GDP we talked about at the beginning? Yeah, it's a tiny drop in a very empty bucket. The International Monetary Fund has actually lowered its economic growth forecast for the UK in 2026 to a meager 0.8%. That puts the UK dead last among all G7 countries. And while growth is basically flatlining, prices? Well, prices definitely are not. Let's break down these sticky inflation numbers. In March, the UK Consumer Price Index, or CPI, rebounded to a 3.3% year-over-year increase. That is way above the Bank of England's target of 2%. Digging a little deeper, auto fuels surged by a massive 8.7% in a single month, which was directly driven by energy shocks from the Middle East conflict. But perhaps the most alarming thing for policymakers is domestic service inflation. This measures internal price pressures, and that jumped to 4.5%. So this isn't just an imported energy problem anymore, right? Inflation is baking itself right into the domestic economy. So the really crucial point here is that the Bank of England has essentially been backed into an impossible corner, and it's creating some fierce internal disagreement. On April 30th, they held their interest rate at 3.75%. But look at the total catch-22 they face. Option A, raise rates to cool down that 3.3% inflation. The problem? That will immediately stifle whatever tiny bit of economic vitality is left in that 0.8% growth forecast. Option B, hold rates at 3.75% to protect the economy. The problem there? They completely fail to control the rising service and energy inflation, letting the cost of living crisis just run wild. Chief economist Pierre Hunts actually voted for a 25 basis point hike, while 4 other members said they'll wait and see if the energy shock escalates. Basically, they are paralyzed. All right, Section 4, the political trust deficit. Now we're at the deepest structural issue driving this whole market panic, the collapse of the traditional two-party system and this massive loss of policy continuity. Now, it's really vital to remember we aren't taking any political sides here. We are strictly looking at how financial markets react to data and events. And with the market fears above absolutely everything else is unpredictability. Recently, the Labour Party suffered historic local election defeats, losing traditional bases, all while facing a surge from the far-right Reform Britain Party. Prime Minister Starmer's leadership is seen as precarious and just riddled with infighting. So when Andy Burnham won his by-election, the market panicked because he represents a more left-leaning faction. The market fears that if he gains power, he might adopt expansionary fiscal policies, which would just blow up that already massive fiscal deficit. Conversely, if the far-right Reform Party gains influence, markets fear a return to the chaotic disruptions of the Brexit era. The market simply does not care if it's left or right, it cares about stability. And right now, the UK is offering none. Finally, Section 5. What to watch next? So, what does this all mean and where do we go from here? Let's connect all these dots and build a quick watch list for the coming days. First, obviously, monitor the UK Labour Party infighting. If tensions escalate or if Burnham formally challenges Starmer, expect the pound to continue its freefall. The key technical support level you want to watch there is 1.3200. Second, keep a really close eye on U.S. inflation data and Federal Reserve speeches. If U.S. inflation runs hot and rate cut expectations cool down, the U.S. dollar will strengthen, which is going to crush non-U.S. currencies even further. Finally, remember that super strong Australian dollar from the beginning of the explainer? Watch China's economic data. If it falls short of expectations, it could severely undercut commodity prices and totally end the Aussie dollar's dominant run. Which really leaves us with this final thought to ponder. We've just seen how a few days of political speeches can expose a terrifying underbelly of staggering debt and stagflation. So, as political turmoil continues to strip away market confidence, can the British pound actually recover? Or, as the UK borrows at levels we haven't seen since 2008, are we just watching the terrifying new normal for any G7 economy carrying a massive debt bomb? Thanks so much for joining me for this explainer. Keep your eyes on the data, stay focused, and I will see you next time as we continue to decode the global markets.